Inflation generally doesn't go up just go up for 24 months and then go back down. I'm not aware of any instance in history where inflation was short-lived. This tends to go up for a long time and then maybe flatten out for a long time. And I think we're just at the beginning of a long-term cycle upward in inflation.
Hi, everybody. David Milan here, Director of Investor Relations with Nighthawk Equity. Today, we'll be hosting part 2 of our series on inflation with Drew Kniffen. Drew, let's talk a little bit about the Fed's most recent comments on inflation and what that means for investors.
Yeah, David, we talked about this about a month ago, but since then, so much has changed. In the last month, the Fed has actually said, we're going to do away with calling inflation transitory. Transitory is this Fed speak word for short in time. And they were using the word transitory to talk a lot about inflation is going to go away. Inflation is short-lived. We're going to get past these supply chain issues. It's just transitory. And recently they've dropped that word. They've said, you know what? We don't think it is transitory. They're essentially acknowledging that inflation is real, that it's not going away. And in fact, the latest data point that we got from the Labor Department had inflation at nearly 7%, which is the highest inflation we've seen since 1982, 38 years ago. It's really scary stuff.
Now, in light of all these recent comments by the Fed, do we anticipate they'll be able to hike rates enough to stop inflation?
Well, they say they will. Now, the Fed actually didn't have the nerves to do this in the late 70s, and they had to ratchet it up to 22% back in the early 80s to finally kill the beast of inflation. So there's a question of whether, number one, you have the political will to do it as far as raising rates so high. But number two, you have the psychological factor. What happens is inflation becomes a self-fulfilling prophecy, right? People expect inflation, so then they expect to get higher salaries. And meanwhile, people come to accept that their carrots are going to go up in price, that fuel is going to go up in price, that their rents are going to go up in price. And once people accept it psychologically, they're more willing to pay more and more, which means that people that are selling stuff are going to try to ratchet up prices. And it's very hard to unwind that psychology. So, inflation generally doesn't go up just go up for 24 months and then go back down. I'm not aware of any instance in history where inflation was short-lived. This tends to go up for a long time and then maybe flatten out for a long time. And I think we're just at the beginning of a long-term cycle upward in inflation.
Now, in light of all of that, let's get to the question that pretty much everyone's wondering. What does all that mean for real estate investors?
Well, ironically, it's kind of good news for real estate investors. Real estate, along with hard goods like commodities, are some of the best places to store your dollars in an inflationary environment. When you look back at time and you see what assets have done well during inflation, these are the asset classes that do well. So rent, which is what we're investing in, renting out units, is one of the biggest components of inflation. So if inflation is going up, guess what? That means that our rents are going up. Meanwhile, our biggest expense, our mortgage expense, is a fixed number. So we tend to be winners in that inflationary environment. It's one of the reasons that real estate is one of the best places to put your money in general, but especially in an inflationary environment.
All right. Thanks so much, Drew. Now, if you're watching this video and you want to learn a little bit more about how to calculate inflation as well as its effects on real estate investing, please visit Michael's real estate inflation calculator at themichaelblanc.com/inflation. Other than that, thanks so much for tuning in, and we'll see you next time.